So, one of the things that you have to have, whatever side of the transaction you're traversing, is expertise. And you simply cannot get better expertise than is on my right here. Goodbody's Stockbrokers are, of course, a household name for many years. They're not only our gold sponsors here today, and this conference probably wouldn't happen without them, but if I would tell you in the past 5 years that they have done 10 billion euros of deals, I think it says it all. They are part of the World M&A Alliance, which is fairly unique in this market. And I'm going to speak to Sarah Bogossian and to Don Harrington, who are both directors of corporate finance, investment banking within Goodbody Stockbrokers. And so obviously, if this is a down round, and I'm not saying it necessarily is, it depends. What I learned from the first panel is, in all this sea of change, sea of geography, sea of world wars, sea of whatever, there will be winners and losers. The people on my right are here to help you become a winner. You're most welcome, Sarah and Don. If we could begin by maybe dealing with the outlook for international investment, Sarah.
Yes, morning, folks.
Is the mic working?
Sound on it?
Yeah. Yeah, well, just in case, we'll have a plan B. Carry on, Sarah.
All right, no problem. Does plan B work?
Yes.
Okay, good. So the outlook, look, the reality at the moment is we're seeing tech layoffs, we're seeing valuation hits, we're seeing a constant stream of negative macro news. So in the short term, the market outlook is certainly going to remain challenging for 2023. However, we're all a bit exasperated from the constant negative news flow, and it is important to say that actually the medium-term outlook for well-prepared companies is genuinely actually quite positive. That may be quite hard to believe when we're consuming so much negative media, but it is actually true. There are many international investors looking to Ireland for investment opportunities. Our domestic VCs and private equity houses, you've just heard some of them talk, are also looking for investment opportunities. As a proof point to this, on the 6th of October, we ran the Goodbody Tech Summit, which had 200 people in attendance. There were 50 Irish tech companies at that event and 55 domestic and international investors. We didn't get that many people on planes and into a room because they didn't have cash to invest and they weren't looking for opportunities. 27 of the CEOs on that day pitched their companies in the room. Most of those CEOs have had follow-up and interest from investors, and some of them have actually received unsolicited offers for their companies. So that's a tech sector example, but there are lots of other examples for other sectors where there is a hive of activity in the Irish economy and there are good investment opportunities. So yes, it does look like the short term and into 2023 is going to be very challenging, especially possibly at the very early stages and also at the very late stages for larger buyout deals. But there is good opportunity in the market for companies to raise capital.
Yeah, just to add to that.
Yes.
Just to add to that. And I'd echo what the last panel said. So the amount of capital, the foundation in Ireland between debt, equity, whether it's Enterprise Ireland, ISIF, all the amount of capital, the availability of capital has never been better despite those headwinds. And we're also, there was a reference to patient capital, I think Donal mentioned in the last panel. We're seeing a lot of investors in funds, so families and former entrepreneurs who've invested in funds looking to co-invest alongside investors in opportunities. So I would say it's never been so good in terms of availability of capital. It's all about the quality of that. But we're also seeing overseas investors coming into Ireland as well. You've like 2 infrastructure deals this year, Hibernia being acquired, Host Ireland, a business we advised, this was acquired by a UK infrastructure investor too. So I'd say there's still a lot of opportunity. There are headwinds, but there is capital for growth. If you were to go back 10, 15 years ago, there was not that availability in the market.
Okay, just on that, I've done a few sort of conferences and people said, this time next year, we might go to base rates of 4%, worst case scenario, but it's not going to last for 2 or 3 years. We might be out the end of this cycle. Do you have any opinion on that, of how long this, change in the interest rate cycle might last? It might be relatively short-lived, or you're not sure?
Well, I don't know as a crystal ball, so I think everyone's just going to, you plan for the worst and hope for the best, I think is the way you adopt on these things. And that's why people are looking to, well, how can I, funding businesses over the next 2 years from your existing resources, being cautious on spend, but not avoiding opportunities as they arise. So
Don't pull the duvet up over your head.
Well, exactly, you know what I mean? But I think corporate balance sheets have never been stronger. Like going in, even pre-COVID, because those who'd survived the last financial crisis came into COVID with very strong balance sheets. The banks are well capitalised. The COVID supports kept those balance sheets in good nick. So I think...
Which wasn't the case in 2008.
Absolutely.
Exactly.
Not, yeah.
Now, so we have ambitious Irish companies here looking to raise capital either for M&A or organic growth. What advice do you give about the right capital and the opportunities right now, Sarah?
I think, look, just to go back to, can you still raise growth in the current market, or still raise capital in the current market? It is definitely more challenging for certain cohorts. It does depend on the subsector that you're in and the stage of growth. It's also just important to bear in mind just how mad 2021 actually was. Like, for context, we did have some investors that were preempting DD in advance of meeting companies and sending them in term sheets on the same day that they met them. And that was all a bit mad. So part of this market reset is a return to a kind of more normalised engagement process where their investors are waiting to meet companies, then they're sending them term sheets, then they're doing their diligence, and that diligence is taking 3 to 6 months to get a deal done. It's not being done in 3 to 6 weeks. And that is actually a more normal, methodical way of going about deal flow. Fundraising and M&A processes are therefore more thorough. Like, there is more diligence being done, deals are taking longer to complete. But there's still investor appetite for deal flow. It is more selective though. So companies are finding that investors are at a high level more focused on profitability, and if you're not yet profitable, that there's a clear path to becoming profitable. There are exceptions to that for deep tech and semiconductors and a lot of R&D companies that are early stage biotech, etc. But at a high level, getting a path to profitability is a key focus for investors because they want to make sure that they're going to get a return on their investment. There's slightly less appetite for certain sectors. If you are a B2C industry at the moment, if you have a really high cash burn, that's not as palatable at the moment. Investors also, when they do get comfortable with all of those things, are looking for a really efficient use of capital. So they want to see credible metrics. They want to see really clear milestones. So companies that can demonstrate that are still in a good position to raise capital. And there are certain sectors that we can see are attracting a lot more investor interest or continued investor interest despite the current environment. So those sectors are cyber, red tech, fintech, anything in the data space. Services business in the B2B space that are growing at pace are still of interest to quite a lot of investors. In the healthcare space, a lot of high growth healthcare companies, med tech, biotech, and also climate tech. Those subsectors are still of interest. And just generally well-diversified companies that have blue-chip clients are still attracting capital. So there is still a certain amount of deal activity in those hot subsectors.
So Don, I think the expectation is if you're facing into raising capital, you must expect a more robust due diligence.
Yes, yeah, absolutely. It's a tougher environment, but nothing unusual. Like I think Conor in the last panel said, if you have a presentation come in, we don't let clients go out with half a presentation. Like you have to be well prepped. You do your homework. You don't go in half cooked. And if you have the right opportunities, it'll stand to you. And the numbers are still there. Like in Q3 of this year, there was over 100 million of, this is on the venture side, of venture capital raised. Now that was down about 50% from Q2, and it was down a lot from Q3 last year, which was 480 million or something like that. But if you go back to 2020 and go back to 2019, it ranged from about the low hundreds up to maybe 180. So it's normalising back to what are normal levels of activity. 2021 was a little bit of an aberration in terms of the amount of capital deployed, and it's now coming back to more normal levels.
Okay, so a CEO lands in front of you or a chairman of a board. What are the key considerations in raising capital, Sarah?
Yeah, similar to the last panel, I'd say in truth, there's nothing new in terms of the key issues that CEOs and founders need to consider. The unfortunate truth is, though, that we still meet and advise quite a lot of companies who aren't properly prepared before they go to market. The simple things are still the most important things to get right, and if you don't, they cost you dearly. So what are the simple things? The simple things from our perspective in talking to investors when you're looking to raise capital are make sure that you have a really clear message and you articulate your investment opportunity well. That sounds really basic, but a lot of companies don't get that right at the early stages. You need to have a really good financial model with clear milestones that shows your growth trajectories and all the assumptions that you have around that model that are clear and that they make sense. You'd be surprised how many companies cut corners on that and think it'll be grand, and it falls over in diligence. Your valuation expectations, a topical point for the current market, and your justification for same. So what is your valuation based on? Is it based on the current market? Is it based on the size of your sales pipeline? What percentage growth are you going to deliver year on year? Investors are also looking for CEOs and companies to demonstrate, again, I mentioned it before, but it is, not to labour the point, but it is important, it's an efficient use of capital that they're looking for. So is it being spent in a high impact way? Does your capital spend map to the milestones for your kind of future growth? They want to make sure that you're not spending money in a way that acquires unprofitable customers. That's especially true in tech, but it's true for all sectors. And if you don't have that stuff nailed and you go to market, you're probably going to have either an unsuccessful process or potentially a price chip in diligence. And you'll also possibly waste quite a lot of your valuable management time. So I think in terms of the key issues, there's two real things to think about. Don't go too early unless you're prepared. And if you are raising equity, have a really good think about the cultural fit of the investor that you're looking to raise money for. Once that person is on your board, once you've got the money in, that person and that entity is on your board, and they will be the person that you go on your journey with and have to deal with obstacles along the way. So remember that you are essentially married to that person and that fund and entity until you separate or divorce, which is hopefully going to be amicable.
Okay. Don, so you've got to raise cash. Debt versus equity. You know, there used to be ratios for all these things. What's the prevailing advice now?
Well, it depends on whether you're an early stage business or a later stage business. Like if you're an early stage business, then and in the current market, you've got to look to have I existing investors on board? Can they fund what I want to do, or is this my first time out to try and raise some investment? So it's all about, if you have existing investors and you still haven't hit some kind of key commercial milestones to go out and raise more capital, well then you should be looking to your existing investors to either put some bridging finance in place to hit those milestones and then go out to market. So maybe delaying going out to do that. If you're a more mature, more stable business where you can use debt as part of your financing either organic growth or M&A activity, well then it's about the state of your balance sheet to a certain extent. Have you raised debt? I've talked about many companies being fairly conservative in their leverage over the last few years and not getting beyond the maybe two to three times in terms of, and that would be high for certain companies. So being cautious about that. And maybe just to use an example about also looking at alternative ways to fund transactional activity. So if you are, the opportunities don't just cease in markets where there's headwinds. So we're advising a company called Missouri Group, which is based in Lisburn in Northern Ireland. And they make blinds and they make shutters. They import some of that material from Asia. But we've been advising them on a buy and build strategy right across Europe. And so we've acquired companies with them in the Netherlands, Sweden, Denmark, the UK, and we looked in other countries. So part of the approach in doing that is we've generally been targeting family-owned founder businesses that are profitable, and it's been cash up front to the founders, sometimes some deferred consideration, or the vendor gives a loan note back to the company to part fund. So a good thing for them is to put money back into the company they know well and get a return on that. And also where there's a management team alongside that founder and they have equity, they've been investing in that company as well, rolling some of their shares. So you're part funding the deal with the vendor and with the management team rolling into it. So being smarter, and also if you're buying a stable, not a high growth business but stable cash flow, probably paying between 7 and 8 times EBITDA for the business.
Okay, let's move on to valuations. First of all, Sarah, how do you get a deal done where perhaps the cap table is possibly overvalued?
It's tricky. There's a lot of discussion happening in the market about this specific topic. A lot of the conversations around this are deeply uncomfortable, and there's quite a lot of conflicts of interest at the tables. So, look, it's really tough for CEOs and boards and investors to agree this amicably at the moment. So, for companies that have raised in the last few months or in the last year, and they raised at very high valuations, some of them are facing down rounds at the moment, and this was mentioned briefly earlier. What happens in this scenario is that often existing investors are tapped out, so they can't follow their money, or they have a lack of willingness to do so. So that means that there's both a need and an opportunity for new investors to come on board. So if management want to go the journey, and they believe and have conviction around delivering their plan over the longer term, it's still quite controversial because essentially existing investors are getting hosed. So it's not easy, and the short-term reality of exit horizons and management teams' longer kind of perspective around what they can deliver over the longer term often mean that depends on where you're sitting in the cap table as to what your view and your perspective is around a down round. As an example, we are working with a UK platform company at the moment, which raised quite a lot of money at a very high valuation last year. It has a lot of staff. It has a really high cash burn rate, and it had a fundraising process that wasn't successful earlier in the year and had to raise money. Existing investors couldn't follow their money, and some didn't want to. And it has just gone through a really aggressive full recap. And what that means is a lot of the previous investors did get hosed. They will not make any return on their money. They will lose most of it. But for the new investors that went into that company, it's very exciting for them. So the key element of that is making sure that in a recap like that, where some investors are losing, that as a management team and a board, that you are making sure that is not going to be on your horizon again, that you are not going to run out of money, and that this time there's something different about how you're going to manage that investment. So it is happening. It's not all bad news. It isn't great if you invested at a massive valuation and the money's now gone. But in general, the companies that we're looking at, they still have added value. Some of it is market circumstances. Some of it is high cash burn. But at a high level, there is a lot of opportunity in the market for new investors, depending on what subsector they're in and how they've spent their money. But there are opportunities in that challenge.
Don, let's talk about the options here. I mean, let's be realistic. Blue chip companies, Apple down 20%, Amazon down 40%. I've invested in some of the IPOs in the Nasdaq myself. They launched at $10, $8. They're now down to $1. You know, robotics and startups and so on. Will founders need to consider holding off selling in the market, or what do they do about an M&A opportunity? What's your advice?
Well, time waits for nobody. So opportunities come. You can't just delay that opportunity for 2 years. You could stagnate, you could lose, you could go backwards in your business. So you can't just stop. So if there can be two reasons. Positive reasons, you can have a partner opportunity. There can be a competitor that's not doing so well, you have an opportunity to buy them, and now is the time to do it. You may have an opportunity to, your demand is growing, but you need new equipment, and you've got to expand your capacity in a factory. All of those things need investment, and you need to try and push forward that plan. So again, it's back down to, if you have a strong management team with conviction, you've delivered in the past, and you have a good relationship with either your lenders or your investors, then you should continue to do that. The other is the negative side. You know, death, disease, and divorce, they're the 3 Ds that kick in and often spark a lot of transactions. They come along without you, in most cases, being very aware of them. And we get a lot of incoming transactions that are driven by those things. And also, Brexit is another advantage. We're advising a German specialist engineering business at the moment acquiring in the UK because they need production capacity there, because doing it from Germany into the UK now could be more challenging. So in adversity, there are opportunities, and I think you still have to progress. So sitting back and going into your shell for 2 years until the interest rate kind of storm passes over is not an option. Okay,
some of the 2022 good news stories, Don?
Yeah, like there's been plenty of good investment. Like I think in terms of on the private equity side, you've seen the likes of MTM Engineering, you've seen Uform, you've seen Virginia Logistics, Revive Active, they've raised some capital as well. On the higher tech side, you've got Keelvar, WorkVivo, Vivasure, and Open, Fresco, and Johnson Hanna, a legal services business we advise, all raising capital between 10 and maybe 30 million. So lots of those. And also maybe a throwback to the past. You mentioned Amazon down a bit, but that's a good example of a company that in the .com, for those of you old enough in the room here to remember what happened, they lost 90% of their value.
Early 90s, this was.
Yeah, no, this was 2000 to 2002 when the Nasdaq dropped about 78%. Amazon's share price dropped by 90%. So in today's money, their share price in mid-02 was 50 cents. But if you bought $10,000 worth of Amazon shares in that time frame, even with your 40% reduction this year, that would be worth $2 million today. So there are good news stories. People do thrive in adversity, and it's often the time to take advantage of a strong competitive position if you have a conservative balance sheet or if you have supportive investors to go for growth.
Okay, so pulling all that together for CEOs in the room looking to raise capital who've come here today, Sarah, what are the 3 key pieces of advice that you'd like to give them?
I think in terms of the 3 key pieces of advice, number 1, from our perspective, given how many companies that we're helping to do this at the moment is one is get organized so that you don't have any surprises. No surprises is the number 1 requirement for us to get you through diligence. If there are surprises, you will simply leave value on the table. That means your transaction prep is absolutely key. If you take shortcuts, it is going to cost you. It always does. So your business plan, your IM, your financials, and the model all need to be rock solid before you go to market. And in the event that you get an unsolicited offer, that can create absolute panic because you're not ready. So if you think that there's a chance of that coming on the horizon, you need to get organized as quickly as possible. Second piece of advice would be know your audience. You need to really articulate a clear equity story to investors. So you need to be able to clearly state what you're going to achieve in the next 2 years. How does that break down in terms of milestones, and what kind of value does that create for investors? So all of your docs, your financial model, your IM, everything should be really clear. It should all align. That's really boring stuff, but it's really true. It's the thing that investors look for as soon as they engage with companies. So if you get those things right, it does really help. Another thing to remember is that you're not selling your products or services to investors. You're selling your investment opportunity based on the problem that you solve in the market and how you're going to generate a return for those investors as you go through your growth journey. And that you, the CEO, and the team are the people to back to make that happen. So you could be a really good business, but if you don't do these kind of things well, you don't come across as a good investment, and that's the difference. And the last and most important point, I think, is actually just don't drop the ball. So very difficult for CEOs and boards not to get distracted during a fundraising or an M&A process. So you do have to have strong conviction around delivering your numbers, making sure that you're going to be able to overcome any obstacles along the way, and that you understand the challenges that you face going through that process. You also have to deliver the revenue when you're going through the process. That can't be dropped or not happen as you're going through. And also, lastly, for CEOs and boards, you do need to make sure that you're sufficiently resourced to keep the BAU stuff going so you don't drop the ball as you go through a fundraising or a sale. So if you do those 3 things well, I think you have a much more higher chance of a more successful process.
All right. Hopefully you'll be around, Goodbody
Yep,
people.
we're here all day.
If anyone would like to talk to them on a one-to-one basis, really crystallized information there on the do's and don'ts and where the market is actually at, and to sort of punch through the fog of negativity there. Don Harrington and Sarah Bogossian, please show.